Alibaba is navigating a transformative phase as it seeks to redefine its growth trajectory amidst regulatory challenges and a competitive Chinese market. The company is heavily investing in its cloud and artificial intelligence AI capabilities, with Alibaba Cloud at the forefront of this shift. By integrating its open-source large language model, Qwen, Alibaba aims to establish a comprehensive AI ecosystem that extends beyond China into emerging markets and Southeast Asia. This strategic pivot involves a significant planned investment of $50 billion over the next 3 years, underscoring Alibaba's ambition to emulate the success of Amazon's AWS in the AI and cloud sectors. If successful, this could become a major growth driver for the company over the next decade. However, Alibaba's core e-commerce business, which remains a critical revenue source, is struggling to regain momentum. Despite a 9% year-over-year revenue growth in the March 2025 quarter, the segment's overall growth remains sluggish due to weak consumer sentiment in China and fierce competition from rivals like Pinduoduo and Douyin. These challenges highlight the ongoing structural pressures in the domestic market. For investors, Alibaba presents a mixed picture. While its AI and cloud initiatives offer long-term potential, the near-term outlook for its e-commerce operations remains uncertain. Investors with a long-term perspective may find Alibaba's strategic initiatives appealing, but those seeking immediate returns might consider other opportunities.
Reddit has reported its most profitable quarter to date, achieving a net income of $89 million, which has significantly improved its trailing 12-month net income to $216 million. This marks a dramatic turnaround from the previous year when the company experienced a net loss exceeding $500 million. Reddit's stock has surged over 500% since its public debut last year, yet the company continues to demonstrate strong performance, particularly in the digital advertising sector. Unlike many tech companies that struggle to balance user growth with effective monetization, Reddit has successfully increased both its user base and its average revenue per user, the latter rising by 47% to $4.53. In the second quarter of 2025, Reddit's daily active unique visitors grew by 21% year-over-year to 110 million, while revenue surged 78% to $500 million. This growth is attributed to an increase in ad impressions and higher ad pricing, setting Reddit apart from competitors like Snap and Roku, which have faced challenges in ad monetization. Despite its high valuation at nearly 24 times sales, Reddit's exceptional gross margin of 91% and its potential for further monetization improvements make it an attractive proposition for long-term investors. With over 400 million weekly users, Reddit's revenue generation still lags behind other major social media platforms, indicating potential for continued growth and making it a compelling buy for those with a 5-year investment horizon.
Claire's Accessories, a prominent U.S.-based fashion accessories and jewelry retailer, has filed for Chapter 11 bankruptcy in Delaware, marking its second bankruptcy filing since 2018. The company, which operates 2,750 stores across 17 countries, including 280 in the UK, is grappling with weakened consumer demand and supply chain challenges. Despite the filing, Claire's UK outlets, including those in Cambridgeshire, remain operational for now. The bankruptcy filing reveals liabilities and assets ranging between $1 billion and $10 billion, with over 25,000 creditors involved. The retailer's financial struggles are compounded by increased competition and a shift away from traditional brick-and-mortar retail. The ownership group, including Elliott Management, which was a creditor during Claire's previous bankruptcy, is exploring strategic options for the business. This includes potential restructuring or sale of its UK operations, with firms like Hilco reportedly interested in a takeover. Claire's CEO, Chris Kramer, highlighted the necessity of the bankruptcy decision due to current debt obligations and macroeconomic pressures. The company is in discussions with potential strategic partners as part of a broader strategic review. This development could potentially influence market sentiment around retail stocks, particularly those heavily reliant on physical store sales amidst a shifting consumer landscape.
Solana has recorded its highest daily transaction volume since 2021, signaling a potential bullish trend for the blockchain network. The platform processed over 100 million daily transactions, marking a significant resurgence in on-chain activity reminiscent of the NFT and DeFi boom, with transaction per second (TPS) metrics reaching around 1,200. Solana demonstrates notable system resilience, attracting institutional interest and potentially driving bullish sentiment. Despite current price stagnation, the increased on-chain wallet activity indicates accumulation and repositioning, suggesting that if transaction demand translates into capital flows, Solana could experience a breakout. Simultaneously, Remittix, RTX, a payments-focused token, has achieved a new funding milestone, raising over $18.5 million and nearing full token allocation. Trading at $0.0895 after a recent 21% increase, Remittix is gaining traction due to its utility in solving a $19 trillion payments problem through direct crypto-to-bank transfers in over 30 countries. The upcoming wallet beta launch and strategic incentives, such as a 40% token bonus for early backers, enhance its market appeal. The convergence of Solana's transaction surge and Remittix's growing utility suggests a synergistic potential for both, with traders considering exposure to Sol and RTX as their usage and utility align.
AppLovin Corporation, NASDAQ, App, has recently experienced a series of positive re-evaluations of its stock price target by various financial institutions, reflecting growing confidence in its market performance and future growth potential. Notably, Wells Fargo and Company raised its target from $405 to $480, while Piper Sandler increased theirs from $470 to $500. Wedbush has set a notably higher target of $620. Maintaining an outperform rating, and Scotiabank has upgraded the stock to a strong buy with a target of $450. The consensus among analysts is a moderate buy with an average price target of $472.33. The optimistic outlook is underpinned by AppLovin's robust financial performance, highlighted by a quarterly earnings per share (EPS) of $2.26, which exceeded the consensus estimate of $2.05. And a 77.1% year-over-year revenue increase to $1.26 billion. Despite the revenue falling short of the projected $1.37 billion, the company's strong financial metrics, including a return on equity of 252.67% and a net margin of 45.72%, underscore its operational efficiency and profitability. AppLovin's stock opened at $455.98, showing a 4.3% increase, with a market capitalization of $154.30 billion. The company's strategic focus on enhancing its software platform for advertisers and maximizing ad inventory value positions it well in the competitive digital advertising space. Despite a high debt-to-equity ratio of 3.01, institutional investors and hedge funds maintain significant confidence, holding 41.85% of the company's shares. Major stakeholders include Vanguard Group and Price T. Rowe Associates, among others. Insider trading activity has been notable, with significant stock sales by executives such as CEO Arash Adam Farugi and CTO Vasily Shikin, potentially indicating profit-taking amid rising share prices. Nevertheless, the company's strategic positioning and strong financials contribute to a favorable analyst outlook and optimistic market sentiment, suggesting sustained growth potential in the tech sector.
Trade Desk Inc., NASDAQ, TTD, a prominent technology company specializing in a cloud-based digital advertising platform, has been assigned a price target of $98 by BMO Capital Markets. This target suggests a potential upside of 80.71% from its current trading price of $54.23. The stock holds a moderate buy consensus rating, with a consensus price target of $92.18, reflecting a generally optimistic outlook despite recent volatility. In its latest earnings report, Trade Desk reported a quarterly revenue of $694.04 million, exceeding analysts' expectations of $686 million and marking an 18.7% year-over-year increase. However, its earnings per share, EPS, were 41 cents, narrowly missing the consensus estimate by 1 cent. The company maintains a market capitalization of $26.65 billion and a price to earnings P/E ratio of 65.34, indicating high growth expectations amid market fluctuations. Institutional investors, who own 67.77% of the stock, continue to show strong interest, although recent insider trading activity, including significant stock sales by CEO Jeffrey Terry Green and Director David B. Wells, adds complexity to investor sentiment. Despite the insider sales, analysts such as Oppenheimer and KeyCorp have raised their price targets, underscoring optimism for Trade Desk's future growth potential. The company's strategic position in the growing digital advertising market remains a focal point for investors as it navigates competition and dynamic market conditions.
Celsius Holdings Inc., Nasdaq CELH, a prominent player in the functional energy drinks market, has been the focus of significant attention from the investment community. The company's stock has been rated as a moderate buy by 18 ratings firms, with a majority of analysts recommending a buy. The average target price set by brokerages is approximately $47.83, although targets vary, with Bank of America setting a lower target of $40 and maintaining an underperform rating. In contrast, other institutions like Truist Financial and Morgan Stanley have raised their target prices, with some as high as $55, reflecting a generally positive outlook. Celsius recently reported impressive quarterly earnings, with revenue reaching $739.30 million, an 83.9% increase year-over-year, and significantly surpassing analyst expectations of $632.13 million. The company's earnings per share (EPS) also exceeded projections, reported at 47 cents compared to the expected 23 cents. These results highlight Celsius's strong financial performance and successful expansion strategy in the competitive functional beverage market. The stock opened at $51.95, showing a 3.7% increase, and the company boasts a market capitalization of $13.39 billion, with a P/E ratio of 140.41, indicating high investor expectations. Despite the robust financial performance, insider trading activity, including substantial stock sales by CEO John Fieldly and major shareholder William H. Milmo, might raise questions about the long-term confidence of those closely tied to the company. However, institutional investors have shown increasing confidence, with hedge funds and financial services firms, including Creative Planning and Commonwealth of Pennsylvania Public School Employees Retirement System, boosting their stakes in Celsius. Celsius's financial health is underscored by a quick ratio of 3.04 and a current ratio of 2.11, indicating its strong ability to meet short-term obligations. As the company continues to expand its product offerings and international reach, it remains a significant player in the functional beverage market, with a promising outlook for future growth.
Maple Bear Inc., trading as Instacart, Nasdaq Cart, has garnered positive sentiment from multiple research analysts, leading to increased price targets and a consensus moderate buy rating. Bank of America raised its price target from $53 to $58, while Needham & Company LLC set a higher target of $66, indicating potential upsides of 13.26% and nearly 29% respectively from the current stock price of $51.21. Additional upgrades came from firms like Loop Capital and Stifel Nicolaus, reflecting strong confidence in the company's market performance and growth trajectory. The company's recent earnings report exceeded expectations, posting an earnings per share (EPS) of 41 cents against a consensus of 39 cents, and achieving an 11.1% year-over-year revenue increase to $914 million, surpassing the anticipated $896.55 million. Maple Bear's financial health is further demonstrated by a solid return on equity of 16.02% and a net margin of 13.76%. Institutional investors such as William Blair Investment Management, Victory Capital Management, Securian Asset Management, and Wealth Enhancement Advisory Services have shown increased interest, acquiring notable stakes in the company. However, significant insider sales totaling over $237 million, including transactions by CEO Fidji Simo and General Counsel Morgan Fong, suggest potential profit-taking or rebalancing by key shareholders. With a market capitalization of $13.44 billion and a price-to-earnings ratio of 29.60, investors appear to be pricing in future growth potential, driven by Maple Bear's expanding online grocery and software services. As the company continues to enhance its market presence, its stock performance and strategic developments will remain under close scrutiny by investors.
DoorDash, Nasdaq has recently received a series of positive price target revisions from several brokerage firms, signaling increased confidence in the company's financial performance and growth prospects. Notable adjustments include Needham & Company LLC raising its target from $230 to $300 with a buy rating, UBS Group setting a target of $280 with a neutral rating, and both the Royal Bank of Canada and Oppenheimer increasing their targets to $300 and $310 respectively, with outperform ratings. Cantor Fitzgerald also revised its earnings estimates for DoorDash, increasing its FY 2025 EPS forecast from $1.71 to $1.97 and maintaining an overweight rating with a price target of $260. The consensus among analysts suggests a moderate buy rating with an average price target of $259.18. DoorDash's recent financial results have bolstered this optimism, with a reported 24.9% year-over-year revenue increase in the second quarter, reaching $3.28 billion and surpassing analyst expectations. The company also achieved an earnings per share, EPS, of 65 cents, outperforming the anticipated 42 cents. These strong results are reflected in the company's robust growth trajectory, evidenced by a return on equity of 9.56% and a net margin of 6.57%. Despite a recent 4.4% decline in stock price, opening at $259.19, the stock remains close to its 52-week high of $278.15. Institutional investors, including Vanguard Group and Capital World investors, have shown significant interest in DoorDash, owning a substantial 90.64% of its stock. This institutional backing underscores confidence in DoorDash's long-term potential and strategic direction. Despite recent insider selling activity by CFO Ravi Inakonda and Director Andy Fang, DoorDash's market cap stands at approximately $109.83 billion, highlighting its significant presence in the commerce platform sector and positioning it favorably against competitors.
First American Trust FSB has reduced its holdings in the iShares Select Dividend ETF, NASDAQ, DVY, by 0.9% during the first quarter of 2025, according to its latest SEC filing. The firm now owns 31,965 shares valued at approximately $4.29 million. Despite this minor reduction, the ETF remains a popular choice among institutional investors, with hedge funds and other institutions owning 46.08% of its stock. The iShares Select Dividend ETF, which aims to track the performance of the Dow Jones U.S. Select Dividend Index, has seen its shares rise by 0.4%, opening at $136.10. The ETF boasts a market capitalization of $19.95 billion, a P/E ratio of 13.69, and a beta of 0.87, indicating moderate volatility compared to the broader market. In addition to recent trading activity, the iShares Select Dividend ETF has increased its quarterly dividend payout to $1.2333 per share, up from 93 cents, resulting in an annualized dividend yield of 3.6%. This move is likely to attract income-focused investors seeking consistent returns in a volatile market environment. The ETF has demonstrated strong performance over the past year, with its price fluctuating between a low of $115.94 and a high of $144.09. As investors continue to seek reliable dividend-paying securities, the iShares Select Dividend ETF's focus on high-yield companies positions it as an attractive option for those looking to balance growth and income in their portfolios.